Welcome back, everyone. I am thrilled you're here today. We are going to be putting on our forensic analyst hats for this one. We're going to look right past all the shiny marketing, and we're going to dig straight into the structural integrity of a brand new case study. We're taking a deep dive into the Diksha Polymers Limited initial public offering. We'll be looking directly at their red herring perspectives to figure out exactly what makes this SME manufacturing business tick, and, perhaps more importantly, where the hidden fault lines might actually lie.
But before we jump in, I need to make our boundaries extremely clear right up front. This explainer is purely for educational purposes and does not constitute financial advice. Please consult a SEBI-registered advisor before investing. Look, we are here to read the data, decode the accounting, and empower you with knowledge. We do not tell you what to buy, sell, or avoid. Period. So to do that today, we're going to start by looking inside their business model, then we'll track those IPO proceeds, compare their profits against actual cash flow, evaluate key risks, perform a quick valuation check, and finally, wrap it all up with a fundamental summary.
Okay, let's dive into this. Section 1, Inside the Business Model.
So, fundamentally, this is a plastics manufacturing business. They operate out of Gwalior, Madhya Pradesh, and they primarily manufacture PET bottles and PET preforms. Think about it. If you've ever grabbed a bottled water, a soft drink, or even just a jug of cooking oil, you've likely handled a product very similar to what they're pumping out. They use these massive, heavy industrial injection molding machines to make the preforms, and then blowing machines to actually expand those preforms into the final bottles that get shipped to the beverage and edible oil industries.
When we look at the hard data, their installed manufacturing capacity stands at 2,163 metric tons per annum for the PET bottles and 1,913 for the PET preforms. But here is an absolutely crucial detail buried in the prospectus. They actually recently acquired the running business of Diksha Packaging, which was a proprietorship owned by one of the promoters. This was a really strategic backward integration. See, before this, they had to go out and buy preforms from Diksha Packaging, but now they've brought all those machines and the entire process in-house.
Moving right along. Section 2, Tracking the IPO Proceeds.
Follow the money, right? When we look at the net proceeds of this 100% fresh issue, a very distinct story emerges. A massive 1,375 lakhs is earmarked entirely for the repayment or prepayment of outstanding borrowings, mostly from Axis Bank. The rest is just going to general corporate purposes and issue expenses. So the absolute key takeaway here is this. Literally 0% of these specific IPO funds are explicitly allocated for new capital expenditure. They aren't asking for public money to go out and build a shiny new factory. They are asking for public money to clear off existing bank debt and clean up their debt-to-equity ratio.
Which brings us to Section 3, Profits versus Cash Flow.
If you just glance at the profit after tax, the surface level picture is incredibly strong. They went from 101 lakhs in FY24, shot up to 263 lakhs in FY25, and reached 411 lakhs in FY26. And that massive FY25 jump, that was fueled by a crazy 116% year-on-year increase in revenue from operations. On paper, it looks like a rapidly accelerating rocket ship. Now, what's really interesting about this is the reality check that comes next. Despite reporting a profit of over 411 lakhs in FY26, their net cash flow from operating activities for that exact same year was a negative 377.2 lakhs. Think about that for a second. They reported a record profit, yet their core business operations actually bled cash. So, how exactly does that happen?
Well, it happens through something called the working capital cycle, which is a notorious trap in the plastics and polymer sector. Let's do a quick forensic breakdown. You make a sale, and accounting rules let you record that as revenue and profit today. Great! But if the client hasn't actually paid you yet, you don't have the cash in the bank. For Diksha Polymers in FY26, millions of rupees got trapped in unsold inventory, which spiked by 268 lakhs, and unpaid trade receivables, which went up by 213 lakhs. So a company can be highly profitable on a spreadsheet, but if the cash is physically stuck in a warehouse or sitting in unpaid invoices, they can still seriously struggle to pay their daily bills.
Let's turn to Section 4, Key Risks and Promoters.
Drilling into the risk factors, 3 major structural red flags really stand out. First up, raw material volatility. They use polyethylene and plastic granules, right? Which are direct derivatives of crude oil. That means their profit margins are almost entirely at the mercy of global oil prices. Second, we have related party transactions, like that recent business transfer agreement with a promoter's family firm we mentioned earlier. But guys, the most shocking data point is their extreme supplier concentration. In FY26, a staggering 96.72% of their total purchases came from just 5 suppliers. And even wilder, over 71% of all their purchases came from just one single supplier. If that one relationship sours, well, the entire manufacturing chain could literally grind to a halt.
All right, Section 5, Fixed Price Valuation Check. Now, this offering is what's known as a fixed price issue. Unlike a book-built issue where investors bid within a price band to sort of discover the market value naturally, here, the company and the lead manager have just drawn a line in the sand. They're offering the shares at exactly 112 rupees each. The main question a forensic analyst has to ask is that 112 rupees actually justified by the broader sector averages?
And this brilliantly illustrates the valuation puzzle we're looking at. At the 112 rupee asking price, Diksha Polymers is coming to market at a price-to-earnings ratio of 9.79. But when we look at the listed peers they explicitly named in their own prospectus, TPL Plastic and Mitsuchem-Plast, their PE ratios are significantly higher at 17.36 and 13.27. On top of that, Diksha is boasting this incredibly aggressive return on net worth of 48.32%, absolutely crushing the peer average. So on paper, it looks really attractively priced compared to competitors, provided, of course, you trust that those sky-high margins and returns are actually sustainable in the long run.
Which brings us to Section 6, the fundamental summary. Let's pull all these separate threads together. On the surface, Diksha Polymers demonstrates a really smartly integrated manufacturing setup with spectacular recent revenue and profit growth. But beneath that surface, we see a business utilizing public funds almost exclusively to wipe out existing bank debt, a business grappling with severe negative cash flows due to heavy working capital requirements, and one that is leaning precariously on a single supplier for the vast majority of its raw materials.
So, what does this all mean? Well, it leaves us with the ultimate question for today's case study. Does that rapid top-line revenue growth and attractive valuation multiple actually justify the negative cash flow trap and that extreme supplier concentration? Look, as forensic analysts, we just spot the data and read the fine print. It is ultimately up to you, the individual investor, to weigh these structural realities against your own personal risk appetite. Thank you so much for joining me on this deep dive in The Explainer. Keep reading those prospectuses, stay curious, and I'll see you next time.